Despite enormous sums of quantitative easing taking place, social unrest and mass economic uncertainty, gold has hit substantial resistance and has actually fallen quite significantly this last week. Today we explore the factors that are holding gold back right now. So let's dive on in. Now, this channel provides global macro insights for informed investing, so do consider subscribing. Now, the macroeconomic outlook for gold remains tremendously positive over coming years, and we can see just how undervalued gold is if we look at the Dow gold ratio, and likewise if we consider the Dow silver ratio as well. So what is going on? Why are these assets so undervalued? Why are we not seeing any price momentum? Well, I believe this comes down to a number of factors that we can see clearly here that we're going to explore in turn. So our first key factor to be aware of is that with the massive liquidity injections by governments and central banks, we've seen stock markets rally dramatically. Looking at this chart, we can see that while the initial falls in the S&P 500 very much mirrored those of the Wall Street crash, stocks have enjoyed a dramatic recovery. And this chart shows a clear discrepancy between the liquidity phase of the crisis 1929 in white and today's S&P 500 in yellow. Thus, many are arguing that this is clearly not a straight out repeat of the Great Depression. Now, of course, the Fed's intervention has been absolutely fundamental here. According to Ron Stoffel, at the height of the financial market panic, the Federal Reserve printed $1 million per second, day and night for 2 weeks. But there remain other forces at work here, which include the overdominance of the fangman stocks, as we can see in this extraordinary graphic. Moreover, in this tweet, we can actually see that, to put things into perspective, the fangman stocks and their market capitalization has just hit a fresh all-time high at $6.1 trillion, equivalent to the combined GDP of Germany and Italy. What's more is that the performance of so many tech companies has been sustained in the face of such economic adversity. This momentum is also being supported with the enormous trend towards FIRE, or financial independence, retire early, driving increased participation in the index funds. This movement argues that you should never sell your investments. Now, such sentiment has been well rewarded by the Federal Reserve, as they have been a primary driver in stock market growth in recent times. Clearly, quantitative easing that actually drives asset price inflation is not good news for gold. This isn't straight out currency debasement that we're seeing here. This is asset price inflation. We must also break down the actual characteristics of current quantitative easing strategy. So far, the vast proportion of new credit growth has gone into feeding asset price inflation. This newly created currency then gets stuck in company balance sheets, and this is why we've seen the velocity of money decline precipitously. Yet there is a vast difference here between credit inflation to drive asset prices and straight out currency debasement. But if you follow the Fed's trades, the easiest profits are to buy whatever the Fed is buying. And just to prove this point, look at how Hertz is now trading above the level where it was before it announced its bankruptcy. This is insane. Now, in the face of liquidity and market momentum, holding no-yield assets such as gold holds a considerable opportunity cost for those seeking short-term returns. Such market distortions are becoming vast as economic fundamentals fail to actually reflect stock market appreciation. This chart shows the increase in the Fed's balance sheet and the driving up of stocks against their 12-month forward price-earnings ratio. That is the share price against the earnings per share. Thus, we can see how dramatically overvalued stocks now are. Secondly, despite rapidly rising government deficits, there has remained continued strength in bond prices. In fact, we can see that, as in this tweet, that stocks and bonds are making two diametrically opposed forecasts for the economy. Gary Shilling says the decline in 30-year bond yields since January foretells continuing economic weakness, demand for safe haven and lower inflation. Stock market rally since March suggests rapid recovery from the ongoing very deep recession. And of course, this is driven by Fed liquidity. Despite clear signs of continued confidence in our fiscal authorities, there are occasional signs of real stress, as we saw after the ECB's announcement on Thursday, the 4th of June, where they committed an extra 600 billion euros of emergency funding support. Yet the following day, bond yields ticked sharply upwards. Nevertheless, we are almost certain to see bond yields go even lower as central banks attempt to manage the entire yield curve. In the end, there will be limited room for further bond price appreciation. Coupled with the risk of currency depreciation as well as the potential for negative yields, it means the upside potential for bonds will continue to diminish, and this is of course good news for gold in the longer term. As we can see here, with 90% of all advanced economy government bonds outstanding trading at a yield lower than 1%, this is very bullish for gold, says Jan Gold. Third, what does history tell us about the potential for gold and silver price gains? Well, if we identified these 2 points here when gold achieved historic all-time highs, they both took place at a time when real interest rates were very low and oil prices were comparatively high. So the real interest rate just refers to the nominal interest rate minus the level of inflation that is actually apparent. Now, this was true in February 1980, where interest rates were around 14% nominally, while inflation topped out at around 13.55%, giving a real interest rate at the time of around 0.45%. Moreover, crude oil hit a then high of $36 per barrel. With crude oil playing an integral role in informing future price expectations, higher crude prices are often good news for gold. But what we can clearly take away from the 1980s highs for both gold and silver is that real interest rates were low and crude prices were high. Moreover, in 2011 we had seen real interest rates plummet and the oil price had recovered from a 2009 low of $41 before hitting $93 or so in September 2011. So what does that mean for us right now? Well, we've already seen a sharp recovery in the oil price, but this table produced by Alasdair Macelod of Gold Money illustrates the gold price against 5-year oil future contracts per barrel on the vertical for this table. The higher the oil price, the greater the potential upside for gold and silver. Clearly, that's not going to happen while economies remain in lockdown. Moreover, we can see that along the horizontal that we have the 10-year Treasury yield interest rates. The lower these rates go, the greater the potential upside is for gold. And you may well be thinking, well, they won't go to -6%, and I'd have to agree with you. Yet the Fed can use QE to have the same consequent reduction upon real interest rates. This is a path they remain on course to fulfill. And when I asked you about how large you believe the Fed balance sheet can go, around 75% of you saw this going well into double figures, over 50% of US GDP. And of course, history tells us that around 5.5% of interest rate cuts are commonly used to actually combat a recession. And we've already come down from 1.75%. That sets us up at around this sort of ballpark figure, given the QE that we can anticipate coming through. Now, additionally, it's worth noting with silver that there's been a fall in industrial output, of course, and this reduces a key component of silver's demand. Yet measurements such as the Dow gold ratio and measuring metal prices against the monetary base tell us just how undervalued these assets still remain. But they do require patience. And so we remain in the hope or the counter-attack phase right now. If you haven't already checked out the theory on the stock market melt up, it's well worth tuning into. Do let me know if you think there's something else that's holding gold or silver back here as well. Now, I hope you found this video useful. Please hit the like button, subscribe, and I'll see you next time. Bye bye.